Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Markets can be unpredictable. This year, we've seen a shift in equity flows and market leadership from a handful of dominant tech names to a broader range of sectors. And in times like this, investors and advisors alike are looking for tools that can help smooth out returns and diversify across market cycles. Fidelity Canada has introduced a new product. This is Fidelity Multi-Alt Equity Fund, a single multi-strategy liquid alternative. It's designed to offer diversification and flexibility through challenging markets. So how do liquid alternatives fit into today's broader market landscape? And how might this strategy fit into a broader equity allocation? To break this all down for us, very pleased to be joined in studio by Fidelity Director of Alternatives, Rory Poole, and Alternatives Strategist, Brendan Sims. Warm welcome to you both.
Thanks, Pamela. Appreciate you having us on today.
Yeah, great to have you here in studio to discuss this. Let's go through why, in this particular moment, you are launching this fund. We'll put that to you, Rory.
Sure. I mean, you mentioned a couple of the key features, I think, in your opening remarks, but simply why are we launching this? It's demand. We've been asked for a product like this for a long period of time, build a product that allows investors like a simplified way to access multiple different types of alternative funds within the Fidelity lineup. That's exactly what we're after here. And if I'm to paint a little bit further a picture for you, when I think of the liquid alternative space in Canada, I think of this like spectrum, if you will. So on one end of the spectrum, we have, the high return potential, high sensitivity towards that of public markets. And then on the other end of the spectrum, you have the low return potential, like ultra low sensitivity towards that of public markets. And the ask from the advice community has been build something that's smack dab in the middle.
Interesting.
And that's what we're after here.
Well, Brendan, there's lots of risk in the markets. There's also been, the vol discussion has been a wild ride through this year. Do you want to just talk a little bit about that? And then we'll drill down to sort of what's in it, but ultimately just sort of getting that vol risk story, as Brendan was mentioning, right.
I think building portfolios methodically is becoming more and more challenging and more complex as we have more tools at our disposal.
Right.
It was once a time that we had stocks, bonds, and or various combinations of the two, and you could access a tool that combined them, would auto rebalance, and that was sort of the launch of the genesis of like a multi-asset solution. And I think that we're no different in a sense that we gained access to liquid alts about 5-6 years ago as Canadian retail investors. And what we're doing is we're tapping into those underlying building blocks and building an alt-of-alt type products that will provide that rebalancing, the methodical construction to offload some of that work. And we've done a ton of back testing. We've put a lot of thought into how this is devised. So we're really excited to bring this to market.
It is really exciting. And as you say, over the last 5 years is sort of when these funds were, the regulations had shifted and this was allowed. It's been a wild 5-year, every kind of market as well for some of these funds to go through, which will make up this multi-strategy. But the actual funds that are alt funds, we can go through them now. Who's running them all? There's an Alt Canada, there's the long short, there's the market neutral, there's Bitcoin, Dan value, right? Is that the other one? They have been through some wild markets and they've held up.
They have, and they're all different from one another. I think that's the key emphasis, which you're mentioning. But for this product particularly, like as the name indicates, multi-alt equity fund, we're using funds that utilize either equity as the underlying or have equity-like risk characteristics associated with them. But they all do it in a different fashion. So whether it's Dave Way and Ritu running long short strategies that tend to have some market exposure. But at the same time, in many cases, lesser than that of a traditional fund. They're going to offer you some potential for continued appreciation, as the market evolves over time. We then have other products in there like Dan's, as you mentioned, global value long short, more of a global investment universe, a little bit more esoteric, much more value biased. And Brett DeLay's market neutral strategy, which is something completely different. Then loop in the Bitcoin allocation and putting them all together, to Brendan's point, in a bit of a curated fashion, create something that's really different for investors.
What do you want to add to that, Brendan? I mean, these are incredible strategies on their own.
All very different. There's 4 underlying active mandates and then a 2.5%, a very small allocation to Bitcoin, similar to that of what we would provide on the 1 to 3 spectrum in our all-in-one suite of funds.
Right, okay.
And I think in combining different asset classes that Rory mentioned have exposure profiles that range the spectrum, like take market neutral for an example. By definition, it would aim to have a beta of 0. According to portfolio theory, is the extent that we can introduce lesser correlated building blocks to one's portfolio. Like if you just took a vanilla stock portfolio, the ability to introduce bonds, or if you took a domestic equity portfolio, the ability to introduce international. Introducing return streams that have a lower correlation is going to push outwards on that efficiency frontier, and all things equal, provide a higher level of risk for this, a lower level of risk for the same level of return, or the opposite in the sense that we can get greater returns for a very similar level of risk. And I think that that's what we're targeting by incorporating alternatives into portfolios. I'm not going to beat it over the head because everyone's quite aware that for about 6 years now, stocks and bonds have been in positive correlation territory. And I think that that is one of the several tailwinds to why allocate to alts broadly. And we're excited to give a one-ticket solution to allow investors to do that.
And let me just add on to what Brendan just said. To ask in like a qualitative fashion to further dovetail off of what we were talking about at the beginning with respect to, why build this fund, is that advisors want a strategy that can provide meaningful diversification for investors, but without sacrificing a disproportional amount of return. Right. So hence kind of trying to be smack dab right in the middle with respect to that spectrum that I explained at the start. And that's why we end up here.
Well, and it's interesting. Let's talk about the portfolio construction and the discussion of the 60-20-20, which you're in, Timur, has been mentioning some time. Lots of people have been talking about this for a little while, and alts filling that 20. So you're providing the stability in theory to a slightly more risk-exposed portfolio. It's a piece of the stability. How does this fund of these different strategies provide that balance? Maybe I'll put that to you, Brendan.
Yeah, whether we're talking 60-20-20 or a 50-30-20, are we stealing from the equity side, the fixed income side? I think that really depends on the end use case or the objective for the investor. And we've chatted about this a number of times. And I think over our tenure, I've never given a straight answer. And that's because it really depends on the investor. But I do think that whether investors are concerned about their duration risk on their bond portfolio, there's a lot going on with respect. Let's just pick on the US right now from a monetary as well as a fiscal policy standpoint that is affecting the trajectory and shape of the yield curve. And I think that as an investor in bonds, there are certain concerns on both the long and short end. So when you're curating that 40% and you do have maybe some concerns about how you're positioned, utilizing something that's not necessarily going to have interest rate sensitivity, but is capable of providing a low vol profile, which is really the allure to bonds in the first place, is let's find something with like a 4 to 10 standard deviation instead of a 10 to 20 like equity world. And I think that by tapping into an alt exposure that is quite capable, we won't list direct numbers, but again, I quote like a 4 to 10, we can get into that target area very easily within the alt landscape. And I think jumping back to that efficiency frontier and reducing the risk of the portfolio, what we're able to do, of course, past performance not indicative of future, but looking at how these building blocks have behaved on an individual basis and what their effects are when being combined is to Rory's point, we've devised a product that we feel has a strong opportunity to take a marginal step down from a total return basis, but take a meaningful or disproportionately larger step down on a risk basis. Right. So we won't get into what those numbers are, but again, that was all assessed, whether it be max drawdown, standard deviation, the opportunity for returns and participation. All of that was weighed against one another when deciding the allocation.
I think even a simpler way to say that is that like you can actually use equities within the realm of alternatives to create some semblance of a fixed income product.
Well, that's kind of the question because
it's not identical because there's things that sometimes are left out. But from a correlation standpoint or a diversification standpoint in terms of an investor's portfolio, the case can still be made.
So let's take it a step further. We're talking about equity, which by its actual nature is liquid, but just discuss the fact that these are liquid alts versus illiquid alts, because that also gets discussed. So these are equities that each day will ultimately provide liquidity. Again, I guess, what does that mean ultimately for this overall solution and for advisors and for investors?
You want to take that or you want me to?
Sure. Each of the underlying solutions, without getting into specifics, for the most part, would predominantly play in North American equities. There are a few solutions that would very much venture on an international scale.
Like Dan's Global.
You got it. Dan's Global Value Long Short would be
Yep.
the most inclined to sort of venture and invest globally. And I think that's great that we're getting a portion of the portfolio to be internationally exposed. I think investors today, especially with what we saw in March and April of this year, tariff related, and really just see international markets more broadly really regain a pulse in more of a sustained fashion than we've seen in, dare I say, a decade or more. Having that international exposure is great, but really to hammer home the main message is we're trading in underlying securities that are highly liquid in each of these funds, and the funds themselves, whether investors would choose to access these on an individual basis through mutual fund or ETF, have daily and or intraday liquidity.
Yeah, liquid and illiquid alts, like they've very different characteristics and considerations associated with them. And like, I think that there's an argument for having both in a portfolio. But particularly, I would say for advisors, that maybe haven't necessarily, crossed over into the alternative world just yet. My kind of thought or kind of call to action to them would be to really give some thought to the liquid alternative side of things, because it possesses, similar dynamics that they would experience within their traditional fund allocation.
I mean, what is there is that they're able to short ultimately within the equity story. What their ability to do is to take some of the best ideas that you have, but then also look at the ones that you would not take a long approach to and balance that out. Do you want to just speak to that a little bit? Because that's what these are doing.
Simply just some more bells and whistles compared to a traditional fund, or more, more tools that the portfolio managers can utilize to do a number of different things, whether it's additional income generation, whether it's better preservation of capital, whether it's increased returns. Really, that kind of this evolution that Brendan alluded to over the course of the past 5 or 6 years is just to give more opportunities to these folks to create differentiated exposures and products to offer to your average retail investor.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Yeah, and the correlations, the story of correlations, how this makes sure that things are less correlated to the directional story for equities. And just come back to sort of the themes of risk. I mean, equities actually have been expensive. There was a big opportunity earlier this year on the US side, obviously, to take a look at equities being less expensive. But just for those coming into something at a moment now, I mean, you can't go very far without melt up being discussed. There's a price risk ultimately there. What would you say to that at this moment?
I think when I look at the market right now in sort of the decision in building and making portfolio allocation decisions, we look and pick on the S&P most notably. It is very expensive. We touched and hit all-time highs. Canada's doing quite well. Of course, that's leading by sort of materials and financials. Both respective indices have room to grow in the tail, if you would, or sort of more from an equal weight standpoint. There are still continue to be a number of sort of lesser valued companies, despite the index as a whole being at excessively what we deem to be historically overpriced based on sort of like a forward PE or Schiller PE. Like, we are stretched from a valuation standpoint. It doesn't mean that we can't earn ourselves out of this. Like, price doesn't necessarily have to go downwards to get more affordable. We could have sort of sales growth, top line growth, margin expansion would be a number of ways to sort of grow our way out of this. And I think that if you look at a lot of the names on the upper end of the S&P, for example, there's a great opportunity for them to earn their way out of this. So they're highly cash generative on a historical standpoint. Like, it really is interesting. Like, you can be expensive for really prolonged periods of time. But in building and curating portfolios for investors, it begs the question of, with net new dollars today, do you want to add to what you already have, or do you want to add to something different? And I think that that's where this comes into play.
Yeah, I'll add to that.
Really interesting. Yeah.
We're in a big old bull market right now, which is great for investors. But to provide some more context around, we particularly mentioned, how the US is expensive, which I think everyone knows. But through the lens of an investor, like, if you think of like a 3-year investment time horizon, let's call that a medium term investment horizon. and you look back over the course of the past 10 years, and you look at 3-year cumulative returns on the S&P 500 on a monthly basis. So like simple math, you got 10 years, you got 12 months a year, you get 120 different 3-year data points.
Okay.
If you look at the 3-year period ended September 2025, that is the second ranked 3-year period from a return standpoint for investors. If you have not got to the point where you're considering, rebalancing or reallocating within your portfolio, you'll probably get there pretty soon. And I think from a solution standpoint, what you want as an investor is, going back to that kind of use case that we talked about at the beginning, is like you want a strategy that, can continue to potentially still have a little bit of exposure to this big old bull market if it keeps going, but have these, additional bells and whistles and potentially meaningful diversification if the market for the next 3 years goes off on a different path.
Okay, that was kind of what I was going to ask next. This multi-strategy that this fund is, are there lots of them out there in the Canadian market? Tell us a little bit about the competitive space. Brendan, maybe I'll put that to you.
That's a great question. I'll take the first portion of it.
Yeah.
I would say that there are absolutely competitor solutions that are similar but not the same. I would say given that they are diversified from their underlying composition, you're going to find very few that are identical to one another or even the same.
Sure. Okay.
And I think that's true for the broader alt space. Like, we'll just dial that back to contrast, like Canadian equities. You have the same universe, the same opportunity set, and a relatively small list of companies. Sector concentration even beyond that.
Absolutely.
If you go to the alt universe and you extend the flexibility to a broader geography, long, short, the resulting net exposure of that, how much cash do you hold because shorting raises cash? You have a ton of flexibilities within long short funds, market neutral funds, which none really are built the same. And sort of studying the space and keeping up to date with what solutions other manufacturers are bringing forth, very few are built on a similar fashion. There are a number of competitors that offer similar solutions, and Rory and I would be on the same page that when we look at the composition of liquid alternatives in Canada, in the various categories, equity, credit, market neutral, multi-strategy, and other, we do see sort of, I guess we would be on the same page that we would feel that the multi-strategy category hasn't seen nearly the growth that it will see in the next few quarters and or calendar years. Because a lot of the providers that are devising these solutions now have a great lineup to draw on for a multi-strat product.
Right. Okay. So you might see more of these. Did you want to add to that?
Yeah, I think it's the direction we're going, quite frankly. And particularly within the retail or advice channel, picking between these different strategies that Brendan mentioned is hard for anyone.
Sure.
It takes time. It's difficult to potentially estimate depending on the market environment that you're in. So manufacturers, thoughtfully putting together these solutions that offer, diversification within themselves, but also potentially
you mean financial manufacturers? Yeah.
Yeah, within the broader portfolio, I think is basically a win-win for everyone.
So that's really interesting because you could say, why not just put one of the long-short solutions, for instance, one of the alts in it to sort of take up a portion of that 20 space, if you want, within the overall portfolio allocation itself. Why do all of these? What's the benefit of having 5 versus, I don't know, 1 or maybe even 2? Is it also just research time for the advisors?
Yeah, I think that is certainly part of it. I think part of it though as well, and hopefully resonates with some of the advisors that are watching today, but with investors, so end investors in particular with alternatives, like I think that there's this kind of like inherent emotional kind of bias or difficulty, if you will, in understanding alternatives, particularly when you're in the bull market that we're in right now. And so, combining a number of these different products to still produce something that's diversified, it creates an opportunity for the advisor to keep the investor invested and realize the actual value of that product over time.
I'll maybe just echo on that and say that in this environment, it's really easy to say just buy the index or just buy this short list of 20 companies.
Yeah.
It's going up. And you could make the argument of like, why not to invest internationally every month or every quarter or every rolling 3-year period for the last 10 years, except for recently. So it's until you can't. And I think that like if you think about something like a market neutral solution, which inherently will have a lower total return profile over the ultra long term compared to something that's bearing risk in markets. it's tough to sit with an investor and provide the rationalization, despite it being there from a technical standpoint, as to why hold this. And I think that baking that in a way that we've done the rationalizing, we've done the studying, we've done the learning how these things behave amongst one another. The idea of putting that in there for that reason, no different than something that's going to be low modest return, cash plus 2 to 4%, but it's there for a reason. It's there to pull down the standard deviation and the volatility of the portfolio in a meaningful way. And it's really hard when sitting across the table or sitting at your computer to push that enter button to really just decide to allocate to something that's not just the highest growing market in the world, which is U.S. equities.
Yeah, that's really, really interesting. With some of the decisions around rebalancing, I mean, if you look at the Bitcoin one itself, it's been quite a rebalancing story for Bitcoin if you're trying to keep it at a certain level within a portfolio because the value of it's gone up so much. What about rebalancing across these? How does that broadly work? We don't need to drill down into each individual portfolio manager's approach necessarily, but what should investors know about this and these funds?
Yeah, we have a rebalancing methodology set up for this product. And as Brendan alluded to, like we've done a lot of modeling around what that looks like. You know, we're trying to balance the necessity to bring some of these weights within the portfolio back in line over time, but at the same time, like, you know, not create a lot of these like massive either tax scenarios or cost scenarios for that of investors. And so it's a little bit different in terms of, you know, how we're treating the active funds within the portfolio versus that of the cryptocurrency allocation, because the cryptocurrency allocation obviously is much more volatile than the other ones that are in there. So we keep, you know, arguably a different type of leash on that versus the others. But the idea is to have, you know, a relatively consistent mix of these products over time, again, to allow investors to actually realize their value as we move throughout the investment cycle.
And why do you think that these particular funds, and let's go back to them for anyone who joined us, maybe forgot what we're talking about right at the very beginning. So we're looking at an all Canada approach. We're looking at a long short. This is David Way. Rita Coomer is all Canada. Brett DeLay, market neutral, and then Dan Dupont is sort of a global value approach, and the Bitcoin that you mentioned there. Why these particular buildings? These are the ones that are there. They've been tested over a number of years, but why are they the perfect together? I guess, Brendan, let's put that to you.
Well, I think let's list the numbers off really quickly.
Sure.
We got 50% to Dave Way's long short. It's a North American-based long short fund, so you're going to have, to a degree, Canada and U.S. in differing allocations over time. You then have Ritu's Canadian long short at a 17.5% allocation. Strictly Canada, a 130-30 allocation. It's net 100% exposed to the TSX. You then have a 2.5% allocation to FBTC or Bitcoin. So you take that is 70% of the portfolio. I think that if you think about that 70%, that's going to be what Rory alluded to earlier, which is directional. And then if you think about the other managers, they'll tend to be more diversifying in nature. You have market neutral with Brett DeLay at 15%, and then you have Dan Dupont on global value long short, which, as the name suggests, has a global scope, tends to have a value tilt over time, and very much historically we would view it to be a diversifying solution that will tend to add value in periods where, on a relative basis, markets are going through a bit of a tough time or heightened volatility. So when you combine them all, they all have a different role. And I would encourage you, reach out to your sales team. You want to learn more about this product and sort of historically how these solutions have done in relation to one another.
Sure.
There's a great story to be told on a calendar year basis, how they sort of ham and egg, if you would, at the right times with one another. So really happy with how they've sort of come together, and they fit well.
Let's talk a bit about what you're going to do next, because you said directionally this is probably where the industry is going. We're going to see more of these multi-strategy approach. There are other approaches out there. They could be fixed income. They could be anything. Do you see more on the horizon?
Most definitely. I mean, there's a lot of different ways that we can go with this. And as I think if many of our viewers are familiar with the Fidelity line of products, you know, we're always looking for new ways that we can offer, you know, a collection of kind of curated building blocks, if you will, to and really any channel that exists out there. And is no different with alternatives. We're starting with this kind of like equity focused product. But, you know, there's no reason in the future why we can't venture off to potentially create different kind of risk profiles or risk allocations using different asset classes or different products.
When you go out to investors, clients, do you find there's a bias, not be the right word, but an inclination for a certain type of investor to want this? Is it generational? Are there sort of hurdles to be jumped to help people understand how these work in certain areas? How do you find that?
I think in thinking about the advisory community that we speak with, all the different shapes and sizes that the advice channel comes in, risk rating of solutions is really important. And I would just touch that this is a low to medium risk rated solution, and that the sum of the parts is low to medium risk. But individually, we would take something like Bitcoin, for example, which on a standalone basis would be deemed a high risk solution, albeit we've entered it at a 2.5% allocation, because at that level, we do see that the ability to sort of add an enhanced level of return with a very low, less than recognizable level of volatility entered to the portfolio comes in. I think that risk is very important. So as we think about the end user, the investor, it would be risk. Like risk tolerance would tend to be, I guess, inversely correlated with age. As age goes up, risk tolerance would go down, all things equal. And I think that for the investor that is seeking a low, modest, or medium risk sort of investment profile on average, they're looking to diversify away from just owning equities broadly. That's where this comes into play. And we can't put an age or a certain characteristic to what that investor looks like, but it's really just anyone that's looking to diversify and lessen the risk of a traditionally all equity invested portfolio as they move through their investor life cycle.
Really interesting. Final word to you, Rory, what would you say? Would you add to the risk discussion just to kind of close out what investors want to have sticking with them?
Yeah, I would just say, I would encourage folks out there to if you have not, delved into the potential benefits of a multi-strategy alternative product in the past, certainly do so. I think there's a lot of potential use cases out there for advisors, which, your Fidelity sales folks or any of the subject matter experts here at Fidelity are willing to debate with you. And we're really excited to bring this product to market tomorrow. And investors ultimately have choice, available in either a mutual fund or an ETF series.
Fantastic. Great to have you, Rory, Brendan, joining us here today. Good luck with the launch.
Thanks, man.
Thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.